Welcome. My name is John Broussard. I'm going to be giving 3 presentations on call options. Presentations are call options for newbies. If you're just starting out in options trading or would like to learn about options trading, these 3 videos are the way to go. We're just going to be talking about call options, what they mean and how to trade them. This presentation is copyrighted. However, you can disclose it to whoever you like as long as you indicate optionsanalysis.com is the source. This presentation is not a recommendation, nor is it any advice to buy or sell stocks or options. It's an educational video showing you all about call options trading. In trading, your results may vary. There is always risk in trading stocks and options. There are no guarantees. The presentation is going to use charts and analysis that are done with the website optionsanalysis.com. To find us, just Google options analysis and click the link that arises. That will get you to the login page, which is shown below. From there, you can look at other videos I've created trying to help you to use our website, get started trading in options. We also have some help guides you can download. If you'd like to subscribe, on the right side, we have a sign up button, or there'll be new button. You pay for your subscriptions using PayPal. Very easy to use. First, let's review what it means to buy a stock. I'm going to use it as an example, buying 100 shares of Microsoft. On a particular day, you look at the Microsoft bid and ask, say it's 29.2, which was a number that occurred in the month of October. If you purchase the stock, that stock stays with you until at least one of 3 events happens. First, after you've bought it and the stock price changes at a later time, you can sell your 100 shares and collect your profits or collect your losses. The company can sell itself to a buyer. When that happens, there is typically a buy price, and if it's higher than the amount you paid for your 100 shares, you'll be making a profit when the sale transacts. And of course, a company can go bankrupt, in which case the value of the stock shares goes to 0. Some of company bankruptcies have been happening in the recent past. Your stock shares, if the bankruptcy or the selling does not happen, do not expire. As long as you hold on to them, and there are companies that have been around for many, many years, you keep accumulating whatever price action there is, as well as dividends. When you want to buy or when you want to sell your stock, there is an ask and a bid. An ask is the price someone will sell you shares at right now, no questions asked. A bid is the price someone will buy your shares from you. Typically, the ask is higher than the bid. The difference is called the bid-ask spread. For stocks, it's usually in pennies. Sometimes there's almost no difference that you can see. During the trading day, as you look at the stock price, there are 3 numbers that arise. They're called the open, the high, the low, and the close. The United States Stock Exchange opens at 9:30 a.m. on Eastern Standard Time and closes at 4. The open is the first trade price. It's the first trade price. The close is the final price after all trades have settled. During the day, the highest value of the stock is recorded as the high, and the lowest value is recorded as the low. These 3 numbers represent what happened to the stock during the trading day, where it started, how high it went, how low it went, and where it closed. You can graph a open, high, low, close of a stock on a stock chart. An example of a stock chart is shown here on the left, or Microsoft. That's happened in the past. We represent the high, low, and close using candlesticks. Right here you see a red candle. It has a wick at the bottom and a little wick at the top. The open, in this case, is higher than the close. The open is the top of the candle, the close is the bottom of the candle. The high is the top of the wick, the low is the bottom of the lower wick. If the close is below the open, the candle is colored red. Over here is a green candle. If the close is above the open, the candle is colored green. If the close is near the high, you get no wick. Also shown on the chart are some other symbols you'll see on stock charts. The little green triangle with the E in it is an earnings. This is an earnings date for Microsoft. On an earnings date, you'll typically see a lot of stock action if the results of the earning were a surprise. They were unexpected by the general public. The D you see here on the chart is for a dividend. This is money that the company gives to their stockholders. Basically, it's profits that are returned as cash in terms of stock ownership back to the stockholders. We won't be using it in the rest of this presentation, but I would like to point out that a doji, which is used in candlestick analysis, is what happens when the close and open are almost the same. And there's an example of a doji on this stock chart shown right here, where you have a wicks with almost no candle body. Those are dojis. Not much happened that day. It opened and closed at the same price. On the right side is a risk graph. A risk graph shows what will happen to your shares if you were to buy them at 29.20, the close, on October 12th, 2012, which is represented by this blue line. This is what will happen to your profits and losses as the stock moves up and down. Once the 100 shares move up, you start making money. And when the 100 shares, if the stock price starts going down, you start losing money. It's basically this nice 45-degree line in the chart. A risk graph of a stock purchase shows that the stock purchase is unlimited in terms of time. It never ends. It's unlimited in terms of profit. As long as the stock is going higher, you're collecting money. It is limited in terms of losses. The stock can only go to zero, and you'll basically lose your purchase price. What is a call option? Typical call option would be, I want to buy one call in Microsoft stock. A call option gives you the right, but not the obligation, to buy from the seller of the call option 100 shares of Microsoft stock at a certain price, which we call the strike price, before a certain date, which we call the expiration date. Notice that it gives you the right but not the obligation. An example is to buy one Microsoft November 16, 2012 call option at a 29 strike. This means that we will be purchasing the right to buy from our seller 100 shares of the Microsoft stock at a price of 29 sometime between now and November 16, 2012. The November 16, 2012 was a future date when this presentation was made in October. You will see this representation of the call option shown here by these categories. It shows the stock symbol, it shows the date, it shows what kind of option this is. Either a C stands for call, a P would stand for put, and what the strike is to the right of the call letter. If you go and look at the available data from a broker, you would discover that the broker is saying at the end of day that day the ask for this call option was 0.85 and the bid was 0.83. So somebody will sell this call option to you at 0.85, and somebody is willing to buy this call option to you at 0.83. The volume on that particular day was 3,320 and the open interest was 6,378. The volume, or how many buys and sells happened on the particular date that you are looking at the call option. The open interest, or how many buys and sells are still outstanding and have not been closed. The bid-ask prices that you see shown by your broker and shown on this web page, on this presentation, have a 100 multiplier to convert them into dollars. So if you was to buy the call option at 0.85, you would actually need $85 shown here to purchase the call option. $85 is taken from your account when you do the purchase, and it's replaced by that call option. Once you've made the purchase, one of the things you can do is buy the 100 shares of Microsoft at 29 anytime between the purchase date and the end of trading, which will be November 16th of 2012, which is the expiration date. Another thing you can do with your call option before it expires is you can just sell the call option. And that would be sell one Microsoft November 16, 2012 expiration call option at 29 strike. Let's take a look at the value that can happen to this call option after end of day in November 16th under different conditions. First thing we're going to look at is what happens to the value when the stock is much greater than the strike price at that moment in time in the future. Let's assume for computation purposes the stock's at 32 at end of day. The difference between 32 and our strike price of 29 is 3. We multiply the difference in our prices by 100, which is also the stock multiplier, because we have 100 shares. That's a profit of $300. So our profits are the $3 we make by selling Microsoft at 32, buying it at the strike price at 29, a value of 3, minus how much it cost us to buy the right to have the call option in the first place, which was 0.85. The difference between how much it cost us and how much we made is 2.15. Multiplied by 100, that's a profit of $215 will be made in the future for this call option today if Microsoft stock ends at 32 on the expiration date in the future. What will happen to this call option if something different happens in the future? What if the stock is less than the strike price? For computational purposes, let's assume that Microsoft ends at 28 on November 16th. The intrinsic value of the call, that is, how much is the call in the money, how much is the stock price above the strike price of 29? Well, 28 is not above the strike price of 29, so the intrinsic value in the call is negative, which means that the call has no value. The call option, in other words, is going to expire worthless if the actual value of Microsoft stock is below our strike. It expires worthless because there would be no reason for us to receive Microsoft shares at 29. We would lose money trying to sell it back unless we thought Microsoft would somehow rebound. So our profits, assuming we do not try to exercise the call even though it's not making money, would be 0. We paid 0.85 to get the call, so our profits, if the stock ends up being below 29, is minus $85. In other words, if the stock stays below your strike price at expiration, the most you can lose is your original purchase price of your call option, and you can't lose anything else. Well, we can take the two numbers that we've computed and we can begin the construction of a call option expiration curve risk graph. One such risk graph is shown on the right-hand side. Let's take a look at the 2 points we've computed so far. When Microsoft is at 32, which is shown right here, the profits we can make is 215. We get that point right there. 215 profits shown on the bottom scale. If Microsoft's at 28, our profits is minus 85. That's shown right here, next to this blue arrow. We immediately note that for all values of Microsoft at expiration below 29, we're going to lose our $85. And we get this nice vertical straight line that occurs with a kink right at 29. Once Microsoft is above 29, we start to make a profit, and that profit starts to take away from the $85 we'll lose until we reach this number, where this blue line is intersecting our risk line right at zero profits, and that blue line is what's called the break-even point. This is the value of the stock where the call option breaks even. The amount of money made by the call option is equal to the amount of purchase price of the call option. You can compute that that number will be 29 plus 0.85, our purchase price, our 29.85. That's exactly where the blue line is, at 29.85. Once the stock goes above that, we can use the formulas we've shown in the prior presentation to compute these other numbers. And once we have them all, we can connect them with this line. And we get what's called the call option expiration risk graph line. This will show you how much money you will make as the stock moves up and down when you reach expiration. Well, how does that call option risk graph line compare to the stock risk graph line? Well, options analysis has the ability to overlay a stock trade on top of an option trade risk graph. And that's what I've shown on the right-hand side. The 45-degree slanted line is the stock trade. The minute Microsoft stock moves above the purchase price of 29.2, the stock trade starts to make money. At expiration, that does not happen in the option trade. And the option trade rides above the profit line of the stock trade by how much money it costs you to buy the call option. But as the stock goes down, the call option has the feature that its losses are limited to that purchase price. These are then the features between the two, the call option and the stock option. The purchase price of the call option dictates where you will be in the profit loss zone and how you will compare to a stock. Now, an option on a stock can have many different strikes. For some stocks, the strikes between 30 and 50 can have a $1 price interval. Shown below is Microsoft, which is a stock below 50 and above 3. These are the October 2012 strikes. We see 14, 15, 16, and 17, and so on. Some stock strikes in and around 25 can have a 2.5 price interval. We see Microsoft had 24, 24.5, 25, 25.5 strikes. So some strikes can be as close as 0.5 difference from each other. And 0.5 happens to be the smallest increment in strikes that any stock can have at the moment. When a stock goes to higher prices, and below is an example for Caterpillar, CAT, it no longer has, Caterpillar is above 50, it no longer has dollar price intervals. The price intervals vary between 2.5, 5, and 10. Shown on this October 2012 strikes for Caterpillar, and sometimes we have a 2.5 spread strike, but sometimes we have a 5 spread strike. There is a Chicago Board of Options exchange. Chicago Board of Options exchange is where the exchange that your options you're trading passes through, and it's the Chicago Board of Options exchange, known as the CBOE, that creates the strikes as needed as the stock moves around. If the stock suddenly has a large movement due to some event happening, strikes get created, but it sometimes takes a while for them to enter into a broker screen and then enter into the optionsanalysis.com screen. When do call options expire? There's a standard. Call options expire on the third Friday of the month, at the end of that day. Understand that there are 3 expiration cycles. For example, if you are in early January, your stock could be one of these 3 cycles. If you were to look at when the options expire for your stock, if you're in the March cycle, you would see expirations at January, February, March, and June of that year. If you're in the January cycle, you would see January, February, April, and July. And the February cycle shows January, February, May, and August. In expirations, there's always a front month, the month that you're in. In this particular example would be January. And there's always a back month, which is the next month. In this particular example, it would be February. When do new call options get created? Well, if they're not already in the cycle, then when an option series expires, for example, let's say in January, on the third Friday of January, the January option series expired, and on Monday, what would happen? Well, in the March cycle, nothing would happen because there's already a March option that's available in the March cycle. However, in the January cycle, when the January options expire, there is no March, and there needs to be a back month for February, so the March options would be born on the Monday following the third Friday in January for those stocks that are in the January cycle. Same thing happens for those stocks in the February cycle. And March options would get started on the Monday following the third Friday in January. Those are not the only kind of expirations that there are in stock options. Another kind are called weeklies. Weeklies mostly expire in 1 week, on Friday. So, stocks that have weeklies will have a weekly expiration on every Friday in the entire month. There's another kind of options called quarterlies. They mostly expire at the end of quarters, basically at the end of the month. There are leaps. These are options that go on for a long period of time. They typically expire in the Januaries of future years, like January 2013, January 2014, but there are leaps in other months other than January for certain kinds of stocks and ETF and indices. But typically it's January. You will hear something called the option chain. The option chain is where you collect all the different options that exist for a stock and put them together into a table. You can order the table differently. In this case, we're ordering the table by strike, from the high strikes to the low strikes. In your option chain, you can see the bid and ask that's occurring for each one of these strikes. At the top of this particular option chain, we have the 25 strikes. So in this case, it's the low strike to the high strikes, 25 strike, followed by the 26 strike. And I'm finding that number right here next to the C symbol. 25, 26, 27, 28. The stock was somewhere between 20, was at 29.2, then 30, and so on. We see for the Microsoft call options near the stock price, we get penny differences between the bid and ask. But as we move away from at the money, the difference starts to grow. And at the 25 strike, it's as much as a nickel. to 10 cents between the bid and ask. How much the bid and ask have intrinsic and extrinsic value is shown on the right-hand side. And what I mean by that is, how much is the option already in the money? For example, 30 is not in the money at all. The stock's at 29. So the entire bid and ask is extrinsic value, shown by the 0.41 and 0.42. The 0.85, as was shown in a prior presentation foil, had an intrinsic value of about 0.12, the difference between 29 and where the stock is. The remaining number, which is 0.65 and 0.63 for the bid and ask, is the extrinsic value in the call option. How much money is it costing you over and above how much the option will be worth at expiration, in other words. And here we have another column you'll often find inside option change, and that's called the implied volatility. We're going to be discussing implied volatility quite extensively in the next presentation. Well, that's your basic call option. Of course, which strike should you trade, what option should you use, and how should they be priced, all remain to be discussed. You can chart a call option just like you can chart a stock. And here on the right-hand side is this red line, and it's a chart of the bid-ask spread of our November call option that we've been studying at a strike of 29. When the stock price is above 29, our bids and asks move above value. Then when it goes below 29, it starts to decrease. This is a chart of the implied volatility we will be discussing later. And notice it just kind of bounces around. It jumps up, it jumps back down. It sort of revolves around an average value. We call this a rubber band effect. Dividend and earnings have quite a bit of effect on option prices and implied volatility. And it was the dividend here that caused this jump in the IV shown there, which we'll be discussing later. On the website optionsanalysis.com, you can chart option volume and open interest, and I have a chart of what that looks like for this call option we've been investigating. It started out with not that much action in the option volume. We had some days with almost no trading. Then, as we get closer to the expiration of the call option, and as the call option gets close to what we call at the money, that is the stock price and the strike price start to become very close to each other. At the money is what's happening to our 29 call option because the stock's at 29.2. Action picks up quite a bit in trading, and that's shown by the increase in option value and the increase in the open interest, the contracts that remain open, even though many were sometimes opened and closed during the day. When you're pricing a call option, we showed one, this Microsoft November 16th 12 call option that was priced at 0.85 with an extrinsic value of 0.65. That is how much extra you had to pay above the expiration price to trade this call option. And it had an implied volatility of 29.65%. We're going to be discussing what that means later. Here's another stock on the same day, STI. Almost the same value of the stock as Microsoft, a value of 29.17. However, in this case, the ask price is 1.99, considerably more expensive than Microsoft, and it had an extrinsic value of 1.82. Why is that so much different from the Microsoft call option? Why can there be such bigger values in almost exactly the same call for the same price of the stock? Here's an even bigger one. QID, 29.14 was the value at end of day on October 12th. For its 29 call option, it has an ask of 2.15, a huge value of 2.01 in the extrinsic value, the price you have to pay over and above the expiration value to trade this call option. Why are these numbers so different for almost the same thing? And the answer is, depends on what the trader's future volatility expectations are for the stock being traded. When you trade your call options, this last presentation, this last file here, discusses one of the things that you need to understand, and that's called broker costs. There are lots of brokers who you can use for trading options. You have your large companies like the Vanguards, the Fidelities, the Schwabs, and so on. They have widely differing prices in what their options trading costs are. You can Google options brokers to see a long list of them. Some specialize in options. Some specialize in offering low rates. Some have advanced tools and some have no tools. If you're just starting out, just starting to trade an option, you might consider a broker called Interactive Broker. They have very low rates. They have a lot of tools, but they have a very nice trading screen. You could trade with that broker for sometimes as low as $1 per contract. So one way to work with a low-rate broker is to use our website, optionsanalysis.com, to find and save the trade and adjust the trade, but do the trading with the broker. The commission cost you will discover when you trade a call option. There is a fixed price per option trade, both when you buy it and you sell it. And remember, every option is going to have an expiration. So every option that you buy, you're going to have commission costs to buy it. You'll eventually have to close this option in some way, and that will involve commission costs in closing them. So there are buying and selling costs that happen continuously. There's additional costs on how many contracts you're trading over and above the fixed price. And if you would like your broker to assist you and not do this online yourself, that costs even more. Now, some brokers offer discounts when you use complex strategies for options trading. These are called multi-leg discounts. We're not going to be discussing complex strategies in any of these presentations, except at the very end when we're going to adjust the call option trade. The next presentation, which will be part 2, which will now get into volatility. Why were those 3 options so differently priced? I want to point out that on our optionsanalysis.com website, there are other videos you could go look at. Some of them discuss more of our features, how to get started if you decide to get a subscription, more details into the risk graphs that I just hinted on here, and a look into fundamentals that we'll be discussing in part 3. There's presentations on moving averages and the technology called Darknet. Thanks for listening, and now watch the part 2 video on call options for newbies. Welcome to Call Options for Newbies Part 1. This is one of 3 videos on how to get started trading call options. If you're just starting out or don't have much experience trading options, these 3 videos are here to get you started. This presentation is copyrighted, but feel free to publish its contents elsewhere as long as you indicate that optionsanalysis.com is the source. This presentation is not a recommendation or advice to buy or sell anything. It's an educational video showing you all about call options trading. Your results in trading may vary. There is risk in trading stocks and options on stocks. There are no guarantees. Many of the examples we show, however, will be profitable. Most of the charts and analysis you'll see in this presentation come from the website optionsanalysis.com. To find us, just Google Options Analysis and click on the link there. It'll land you on our login page shown at the bottom. Our login page has other free videos for you to look at, Kindle guides to download. Here's where you can log into our website if you have a subscription. To get a subscription, click Sign Up on the right side. Under Sign Up, if you have a PayPal account or create one, it's easy to sign up using PayPal. We've been in the option trade analysis business with websites since 1997. We're going to start by first discussing what it means to buy a stock. We're going to use Microsoft as our stock as the example, and we're going to we want to buy 100 shares of Microsoft at 29.2. That was the close price on October 12th, 2012. Once you buy the stock, the purchase is yours until you decide to sell it in the future, or the company sells itself to a buyer, in which case your shares would be converted into the new stock, or they would get bought out at the purchase price of the buyer, or the company goes bankrupt, in which case your stock goes to zero. Stock shares don't expire if none of the above events happen, and they are yours to keep, and you'll keep accumulating dividends if the stock has a dividend. Your stock shares will show a bid and an ask when you try to buy it and when you try to sell it. The ask is what somebody will sell you shares at, the ask price. Like when you look at selling a house, the ask price of the house is what you see as the listing. The bid is what somebody will buy your shares at, called the bid price. If you already own stock and you would like to sell it, the bid is what you can get for your stock, no questions asked. Sometimes there's a spread between the ask and the bid, a difference. Typically in stock purchasing, it's pennies. In options, it can be quite large. A stock during the day has 4 prices that we tend to focus on. They're called the open, the high, the low, and the close. The stock exchange opens at 9:30 a.m. Eastern Standard Time. That's also when the options open. And both close at 4 p.m. Eastern Standard Time. Options don't trade after hours, but some stocks do. Open is the first stock trade price. Close is the final price after all trades are settled, after the market closes. During the day, the highest price the stock goes to is called the high, and the lowest price the stock goes to is called the low. Those are intraday prices. You can go back in time and chart the open, high, and low close prices of a stock, and we've done so on the right here. On the left here for Microsoft. To chart the open, high, low, and close, we use something called candlesticks. Down here on the left side is a red candle, shown right here. It has a body and wicks on the top and the bottom. If the open is higher than the close, we draw the candle body at the open and at the close, and we color it red when the close is less than the open. The wicks extend to the high at the top and the low at the bottom. If the close is higher than the open, the candle is green, shown here. Phenomena that's on this chart that we won't discuss further is the doji. The doji is when the open and close are almost the same price. You get a candle with no body. And there's an example of a doji in the Microsoft chart shown right there. Also shown on this chart are a triangle E that's green. That's earnings. When a stock has an earnings surprise, a value of earnings that was unexpected, you can have a large movement in the stock, and Microsoft had a decent move after earnings, shown in the chart right here. This gap that you see in the stock chart. The blue is dividends. Dividends is the company makes profits and returns it to its investors. On the right side is a stock chart risk graph. A risk graph is a chart of what will happen to your profits and losses as time goes by and the stock price changes. The blue line passes right through the close of 29.2 that we purchased our stock at. The minute this Microsoft moves above that, this is how we would start making money. If it moves below that, that's how we would start losing money. There's no limit to our profits, but there's a limit to our losses. Stocks can only go to zero, in which case you lose your whole purchase price. So what is a call option? On October 12, 2012, we decide to buy one call option in Microsoft stock. This gives us the right, but not the obligation, to buy from the seller 100 shares of Microsoft at a certain price, called the strike price, before a certain date, called the expiration date. So one way of describing this was, we would like to buy one Microsoft November 16, 2012 call option at 29 strike. The November 16, 2012 is the expiration date of this call option. 29 is the strike price. We have the right to buy from the seller 100 shares of Microsoft at 29 before November 16, 2012. It's sometimes coded this way at your broker. It shows the stock symbol, the expiration date, CRP for call or put, and the strike. The price of this call option, if you go look it up, has an ask of 0.85 and a bid of 0.3. Someone will sell you this call option for 0.85 and someone will buy it back from you for 0.83. The volume of this call option on that date was around 3,000 and the open interest was 6,000. The volume, or how many contracts happened that day. The open interest, or how many outstanding contracts are still open. The bid-ask prices have a 100 multiplier to convert to dollars. To convert the 0.85x of this call option to how much did it actually cost you, you multiply it by 100 and you get $85. $85 is what will be taken from your broker account and replaced with the Microsoft Strike 29 call option. There are many brokers who do options trading. You can Google them by Googling the word option broker. Some brokers specifically specialize in options. Some have low rates, others do not. Some have advanced tools and some have no tools. One way to option trade is to use our website to find and save your trades, adjust your trades, then use your broker to make the trade. When you make a trade and you can discover what the bid and ask is from your broker, you just enter it on our website in the trade that you're looking at. Brokers have widely different commission costs. There's two parts to the cost. There's the fixed price per option trade, and there's an additional cost depending on how many contracts you buy, how many options you buy. You don't have to just buy one, you can buy 10, 100, 1,000. If you want to use your broker to assist you in the purchase of your options, that's going to cost you more than just doing it online yourself. But when you trade complex strategies that we are not going to discuss, you can get what's called multi-leg discounts. If you're just starting out, one broker that has low rates and a very nice trading platform is interactivebroker.com. Check them out. So we're looking at our Microsoft November call option at a strike of 29. We have the right to buy Microsoft at 29 anytime between October 12th, when we bought this call option, to its expiration in November. Now, there are many things that can happen to this call option on our way to expiration, and one of them is at any time we can sell this call option. We can sell it at whatever price we find out in the open market. We can sell it at the bid for sure. We may be able to sell it higher than the bid. As we approach expiration, we have to ask ourselves, well, what is the value of our call option? What does it turn into? So let's do it with two examples. The first is what happens when the stock price is much higher than the strike price. Let's assume Microsoft will end at 32 on November 16th. At the end of the day. We can buy Microsoft at 29, which means that we could immediately turn around and sell it for 32 and make a profit of 3 points. Since we have 100 shares, we make a profit of $300. We take the 3 that we got, if Microsoft is at 32 at expiration, minus the 85 points that it cost us to buy the call option, and we get a profit, when we multiply by 100, of $215. The value of the call option by buying at 29, selling at 32, minus the purchase of the call option of 0.85. What if the stock is less than the strike price? Let's assume Microsoft is at 28 in November. Well, we would not want to buy Microsoft at 29 and sell it at 28. We would immediately lose money. Instead, we would just simply, if we really wanted the 100 shares of Microsoft, we would simply go buy it at 28, the value it's at now. That means our call option has expired worthless. It has no value. We will not exercise it. It's cheaper for us to just go and buy the stock at 28. So our profits are 0, the value of our call option, minus how much we paid for the call option of 0.85 for a loss of $85. So the most you can lose when trading a call option, if the stock is below the strike price, is your original purchase price. Let's take these two numbers we've got so far and start to try to create a expiration risk graph of this call option. Well, we got the point when Microsoft is at 32 at expiration. We get a profit of $215 shown by this blue arrow right here, $215. That's this point. We know at 28 our loss is going to be $85, shown by this point right here. Well, based on our loss calculation, we know that for literally all Microsoft prices below 29, it's going to be a loss of $85. So we can draw that vertical line from 29 downwards. Now, as Microsoft goes above 29, the call option starts to make money. It becomes desirable to exercise the call option and then immediately sell it back at the higher price. As we do that, we discover there's a break-even point, a point where the stock has risen enough to overcome our purchase price. And that's easy to compute. We take our strike plus our purchase price, add them together, and that gives us 29.85, what we call break-even, where the profit turns to 0. Above 29.85, which is represented by this blue line in the stock chart, that's when we start to make money at expiration. And we can take our other formula and compute each of these points at all the different Microsoft stock prices above 29.85, connect them together to get this straight line. And that becomes our call option expiration risk graph line. And that's exactly how it's constructed. We can compare the call option risk graph line to the stock risk graph line. And optionsanalysis.com has a tool called Overlay where we can do this. I've overlaid the two kinds of instruments for trading Microsoft on top of each other on the right-hand side. We see at the purchase price of 29.2, the stock immediately starts making money. And this will be its line when you buy the stock, and this will be its line at expiration of the call option. It doesn't change. It doesn't have any time value. This is the expiration line of the call, and we see that if the stock stays at 29.2, this option will lose money. It'll be slightly in the money because our strike's at 29. And it will have to rise above 29.2 to start making money. So it does not make money as fast as the stock does at expiration. But if the stock goes down, our losses are limited to our purchase price. Whereas in the stocks of Microsoft, our losses are not limited, and they keep going down could go down until the price goes to 0. Call options can have many strikes. Now, which one you choose to trade with is a subject of discussion we'll have later. But I want to just discuss that when a stock price is between 3 and 50, you can have, for some stocks, dollar price intervals. Here's Microsoft, October 2012 strikes. We have dollar strike intervals all the way from 14 to 46, with the stock sitting somewhere above 20. When we get near 25, we can have 2.5 price intervals, and that's shown right here. Microsoft had 24, 24.5, 25, and 25.5. So some strike intervals can be as small as 0.5, and that's actually the lowest they can be. Once a stock price gets above 50 and gets into the higher numbers, the strikes start to have intervals of 2.5, 5, and 10. Here's an example of Caterpillar, which has a price in the 80s and 90s, and we see that its strike difference is a smallest of 2.5 and a largest of 5. Who governs these strikes? That's done by the Chicago Board of Options Exchange, the place where option strikes are created as the stock moves around. It takes a while for the CBOE strikes to get to your broker screen, and it takes longer to get inside the optionsanalysis.com website, perhaps a day or two. When do options expire? There's a standard expiration date, and it's the third Friday of the month. Options have 3 expiration cycles. Your stock is in one of these cycles. There's a March, January, and February cycle. If you assume that you're in January of 2012 and your stock has the March cycle, then you would see expiration dates in January, February, March, and June on the third Friday of those months. There's always a front month, in this case above, which is January, and there's always a back month, in the case above, that's February. When does a new call expiration option get created? In the above example, after the third Friday in January, the following Monday, if there is no March options, and there aren't any in the January and February cycles, that's when the March option back month starts trading. That's when it gets created. If there's already a March option, like in the March cycle, it doesn't happen. Third Friday of the month expirations are not the only ones. There's also options that are called weeklies. A weekly expires in about a week, on the Friday of that week. For each week in a month, you can have a weekly for some stocks. Not all stocks have weeklies. Quarterlies expire at the end of a quarter, typically at the last day, trading day of a month. There are also leaps. These are long-term options. They typically expire in January of a year in the future. So there are January 213 leaps, January 214 leaps, and so on. Some indices and stocks have leaps that are not January and occur in other months. Option chain. When you look at websites, you will discover something called an option chain. An option chain is nothing but a table showing you all the different types of calls and puts that are occurring for your stock. This is an example of an option chain for November 2012 Microsoft call options. The option chain is ordered, in this case from 25 to 33, top to bottom. The stock is at 29.2. The strikes are 29, 28, and 27. The bid and ask numbers for this 29 call option, which is the one we've been focusing on, has penny spreads. But as we get to the 25 strike call option, the spread widens, in this case to 10 cents. The extrinsic value is how much we're paying for the option over and above its inherent cost. The 29 strike call option has an inherent cost of about 0.2, so with a 0.85 AX, we're paying 0.65 to trade that option over and above its expiration intrinsic cost. Strikes above 29, like 30, are entirely extrinsic, and strikes below 29 start to become more and more less extrinsic. The 25 strike call option, for example, is almost all intrinsic value. You pay very little extra money to trade those call options. They're called deep in the money options. The strikes over here at 33 are called far out of the money options, and the strikes that are near where the stock close is are called at the money options. Our website allows you to display and trade and analyze options using 2 assumptions, which you choose. One is called the mid-quotes assumption. In the mid-quotes assumption, we average the bid and ask to get the mid-quote value. So 0.84 would be the value we would assign to this 29 call option here, and 4.25 for this in the money call at the top. But you can set the website to use natural prices. In natural prices, we would buy an option at the ask price and sell an option at the bid price. You typically, when you trade with a broker, can usually get a better price than the bid price, but not as good a price as the ask price. Somewhere near the mid is a good way to start, and you typically feel somewhere between the bid price and the mid quote price. On our website, you can chart call options just like you can chart stock prices. This second chart shown here is a chart of the bid and asks for this November call option from Microsoft we've been studying. When Microsoft was above 29, the bid asks increased in value, and when Microsoft dropped to 29 and below, the bid ask came down, like you see here. In the next presentation, we're going to be discussing something called implied volatility, and here's a chart of it, and you can see it bounces around. Sometimes it's high, sometimes it's low. Seems to have like a rubber band effect around some nominal value. Some other things you can chart on our website is what did the options call history volume look like, and that's the top chart. In the beginning, there was an initial surge in trading and then not much happened. In some cases, we hardly had days with almost no trading. But as this call option gets closer to expiration and closer to at the money, the option volume increased dramatically. The open interest has been accumulating since it started and has also increased as we've gotten at the money in this call option. This first line is the Microsoft 29.2 close price for a 29 call option. It had an ask of 0.85, an extrinsic value of 0.65. Here's another stock on the very same day with almost the same stock close price of 29.17. It also has a 29 November 16th call option available for you to trade, but its ask price is 1.99. An extrinsic value of 1.82. Why is this call option so much more expensive than the Microsoft call option? Here's another call option in QID. It also has a close price very close to Microsoft. Its ask price is 2.15. It's even more expensive. Why is there such a price difference between these three stocks in their call option ask price? The answer is each of these symbols has different future volatility expectations. Volatility and its expectations are going to be what we discuss in the next presentation. Call options for newbies, part 2, volatility. If you're interested in watching other videos on our website, go to our login page. You can watch a video discussing our features. If you become a subscriber, please watch a video called Getting Started. It shows you some key things you need to look at and set up in your own account to get you started. We have stock lists that get carried around all over our website. How to use them and how to populate them is in a video called Stock Lists. I've touched on the risk graphics. There's a video completely on risk graphics giving you details of the risk graphics page, which is quite a complicated page. Well, thanks for watching this video, and now on to part 2.